Your credit score has no idea how much money you make. It has never seen your salary. It does not know you got promoted. The number that can move your mortgage rate, your car loan, and sometimes whether a landlord calls you back is judging you on something else entirely. A lender may ask about your income on the application, but the score itself never sees it. And there is one of the biggest inputs in the formula, a number most people push in the wrong direction precisely when they think they are being responsible. I will show you exactly which number it is. But first you need to see what the score actually is, because it is not what it pretends to be. A credit score is not a grade for being good with money. It is a prediction, one question, asked by a formula that has never met you. How likely is this person to miss a payment in the near future? That is all. It does not care about your savings. It reads your borrowing file and only your borrowing file, like a very old accountant who refuses to look up from the paperwork, which produces some genuinely strange results. You can earn $400,000 a year and have a mediocre score. You can be broke and have an excellent one. The formula is not measuring wealth. It is measuring behavior around borrowed money, and mostly it is measuring two things. The first is the obvious one. Do you pay on time? That is the biggest single factor, and there is no trick to it. Pay on time every time, with the minimum on auto pay as a safety net. That part is boring, and you already knew it. And the second one is the number nobody explains. Okay, here it is. The formula cares enormously about what fraction of your available credit you are actually using, not how many dollars you owe, what percentage of your limits you owe. The industry calls it utilization, and it is a fraction. Your balance is on top, your credit limit's on the bottom. Watch what that fraction does, because it behaves nothing like common sense. Two people each owe $2,000 on credit cards, identical debt to the dollar. The first has one card with a $2,500 limit. $2,000 divided by $2,500, she is using 80% of her available credit. To the formula, that looks like a person straining against the edge of what she can borrow. It reads as stress. The second has cards with limits totaling $20,000, same $2,000 balance. $2,000 over $20,000 is 10%. It reads as calm. Same debt. Opposite signals. The formula never asked how much either of them earns, and it never will. It only looked at the fraction. And once you see the fraction, three strange doors open. Door 1. Closing a paid-off card can lower your score. You finally clear a card, and the satisfying move, the ceremonial move, is to close it. Feels like progress. Now watch the fraction. Say you have $3,000 of balances across your cards and $12,000 in total limits. That is 25%. You close a paid-off card that had a $5,000 limit. Your balances did not move. Your limits just fell to $7,000. $3,000 over $7,000 is 43%. Nothing about your life changed, and your fraction nearly doubled overnight because closing the card did not touch the top of the fraction. It shrank the bottom. You did not get riskier, you got mathematically smaller. And one myth to clear while we are here. Closing a card does not instantly erase its history. A closed account in good standing can sit on your report for years. The immediate hit is simpler than that. You just deleted a chunk of your available credit. Door 2. You can pay in full every month and still look maxed out. Many issuers report your balance to the credit bureaus around the day your statement closes, not the day your payment is due. So if you put $3,000 a month through a card with a $4,000 limit and pay it in full at the due date, like a responsible adult, the number that gets reported can still be the big one. On paper, you can look like someone riding at 75% month after month without ever paying a cent of interest. The score often sees a snapshot, not every payment you made inside the month. Door 3, and this one is mercy. Utilization can move fast. In the scoring models most lenders still use, recent reported balances carry a lot of the weight. Lower the balance that gets reported, and the fraction improves as soon as the new number reaches the bureaus, often within a cycle or two. Some newer models do look at trends over time, so it is not literally memoryless. But the contrast holds. A late payment can follow you for years. A bad utilization month can often be fixed by next month. Quick note before the useful part. This is general education, not personalized financial advice, and it describes U.S. credit scoring. Other countries can work very differently, and even in the US, different scoring models use the data differently. Check how it works where you live. Now, the move. And then, here it is in one sentence. Protect the bottom of the fraction and time the top of it. Protecting the bottom means thinking twice before closing a card that costs you nothing, especially when closing it would delete a big chunk of your available credit. An open, paid off, no-fee card is not clutter. It is denominator. It sits there, making every other balance look smaller, and its age quietly helps too. A small recurring charge on autopay keeps the bank from closing it for you. Timing the top means one scheduling change. If a card regularly reports a high balance relative to its limit, pay part of it down before the statement closes, not just before the due date. Same money, same month, different snapshot. Neither move costs you $1. It is the same life, reported differently. Now, zoom out, because the score itself is not the payoff. The score is a middleman. The real prize is the borrowing terms a stronger score can help you qualify for. Say you are getting a $300,000 mortgage over 30 years, and the difference between a decent score and a strong one works out to 0.5% on your rate. An assumption, because real rates depend on more than the score. Income, down payment, the market that week. At 7%, the payment is about $1,996. At 6.5%, about $1,896. $100 a month for 30 years. Around $36,000 riding partly on a fraction most people have never once calculated. That is what makes utilization unusual. Payment history takes years to build. Account age literally requires time. Reported utilization can often move by next month. Fix the fast thing now and let the slow things age. Now the honest part, because this does not work the same for everyone. If a card charges an annual fee you are not using, keeping it open is not free denominator. It is a subscription. Do that math separately. If having an open card means you will spend on it, close it and take the score hit. A worse fraction is cheaper than a real balance at 24%. The formula is not the boss of you, your actual behavior is. And do not open a stack of new cards to inflate the bottom of the fraction. New applications leave their own marks, and a drawer full of fresh cards makes the file younger, not calmer. This works with the cards you already have. Now the objection, and it is a fair one, isn't this just gaming the system? No. It is stopping the system from misreading you. You are not borrowing $1 more or less than before. You are making sure the snapshot matches the behavior that was already true. The person paying in full every month was never risky. The file just said otherwise. The second objection is the myth that will not die, that you should carry a balance to build credit. You should not. Carrying a balance means paying interest, and interest buys you nothing here. The file shows the same on-time payment either way. Whoever started that rumor has cost the public a fortune. So, this week, 3 things. 1, calculate your fraction, every card, balance divided by limit, then all balances divided by all limits. Most people have never once seen their own number, and it takes 5 minutes. 2, find the statement closing date on your busiest card. It is on the statement, and it is not the due date. If that card keeps reporting a high balance relative to its limit, move part of the payment a week earlier. 3, before you close any card, run the 3-question check. Does it charge a fee? Does it tempt you to spend? And how much available credit disappears with it? If it is free and harmless, leaving it open is often the easier call, because your credit score still has no idea how much money you make. It never will. But now you know exactly what it is looking at instead.